Welcome back, career students. This is Mr. Clem. In previous videos, we have covered the earnings side of things and we have covered the payroll tax side of things. We are now going to take a look at some benefits along with some pre and post tax deductions. Now, pre means before and post means after. So as you look at your paycheck, and again, we're talking more adult full-time work, career type work. We're not necessarily talking about, working at Albion Ridges Golf Course for a summer job or Charger Kids Club or whatever it is you do, working at Quick Trip or Jack's. We're talking more full-time work where benefits matter, where some of these deductions may matter. Right? So you may elect to have some of the money that you earned withdrawn from your paycheck either before it is taxed, hence why we call it pre-tax or tax deferred, and you may have some deductions that are going to come out of your paycheck after your paycheck is taxed. Rather than asking you to write a check, they're going to go ahead and say, we'll take it out of your paycheck for us. You tell us and we'll do that for you, to cover various things that we'll talk about here. When we look at tax deferred or our pre-tax options, what are some of those things? One of them here is going to be called a 401k and a 403b, employee contributions towards retirement. It's tax code 401k or tax code 403b that allows you to deduct this money and invest it for your retirement. So you got to wait till you get old before you're able to get it. Now, we'll get much deeper into these when you take a personal finance class. But these are some of your pre-tax or tax deferred deductions. Some pension contributions may also be a pre-tax deduction. We have things called flex medical and flex daycare, which are similar but not identical to something called a health savings account. Right? These are all deductions that are going to come out of your paycheck before your paycheck is taxed. So you earn $1,000 and you want to invest some, or you want to set some aside for regular medical bills, or set some aside for whatever. They will reduce your earnings and then they'll have a lower or a new taxable amount. And then your payroll taxes, your federal, state income, your social, your Medicare will be taxed on that lower amount, or often called taxable income. Why is tax deferred a good thing? Well, to me, two reasons. One thing, when you're out there full-time working and you're in a marginal tax bracket of 22 to 30 some percent, you're saving money on that investment. If Clem earns $1,000 and he pays roughly $300 in taxes, and then he decides to invest $100, he takes home about $600. If Clem earns that same $1,000 and he's going to invest in a 401k or a 403b or a health savings account or whatever, my taxable earnings drops down to $900. And if I pay that same 30% income tax on it, I'm taxed at $270 and my take home is $630. Right? So I'm saving, or I'm ahead 25 to 30%. Because I'm either putting this money aside or investing this money before my paycheck is taxed. Okay? The other part is I put in quotes, forced investing. You choose to do this, right? No one's going to make you put money in a 401k. Nobody's going to make you put money in a health savings account or flex medical or daycare. But if you do, if you elect to do it, your employer will take that money out before you even get a chance to spend it. And again, if we were in class, I'd come up with the example of how many of you had a goal to save for something. And all you did was just wait till the end of your paycheck and wait till the end of the month and say, how much money did I have? And a lot of people would go, yeah, I didn't meet my goal. where if as soon as you got your paycheck, you took whatever the number is, $50, $100, set it aside before you got a chance to spend any of your paycheck, you'd have a much higher likelihood of having money set aside to achieve that goal. Well, you're telling your employer to do this for you before they even give you your paycheck. So again, you're choosing to do it, but that money comes out and you learn to live on what's rest, right? Or what's left. Sorry, better way of saying that. So why is tax deferred, again, in my opinion, a good thing? It's not the be all end all, but why is it a good thing? Saving because your tax liability gets smaller and you're saving before you get a paycheck and you're more likely to do it. So as we take a look at these, and again, just briefly glancing at what the ideas are, a 401k and a 403b, these are retirement investing accounts where you can put up to about $20,000 in a year. Now that number changes year to year. Currently, it's right around $20,000, a little more. So that could be upwards of $850 a paycheck, and that's a lot of money, right? You may not be able to put $850 per paycheck in when you just start working, right, in your early 20s or 30s. But the sooner you start putting money away, time value of money says that money's going to grow and grow exponentially. There's more than this, but ballpark, you need to leave it until you get old, like age 60. At age 60, you can start dipping into that money without penalties and fees, but you are going to have to pay tax on it because it's a tax-deferred idea. As we look at some of our costs, some of the benefits that employers will provide or may provide is this flexing, right? Flex daycare, flex medical. The concept is you can set money aside before your paycheck is taxed, either to pay for appropriate child care, and that could be a daycare person, that could be a daycare association, that could be a Charger Kids Club type thing, or for qualifying medical expenses. Deductibles or copays or surgeries or medicines. The catch with the flex money is it is use it or lose it money. So if Clem sets aside, $1,000 in flex daycare, and by the end of the year, I didn't spend it or I didn't use that money, I lost it. That's money that they took out of my paycheck that I don't get back, right? If I move jobs, that's money I lose, right? So you want to be a little conservative in your estimates if you're going to use this, because if you don't spend it, you don't get it back. Again, it's going to be set aside pre-tax for qualifying medical or daycare expenses, and you don't use it up, you lose it. You may see this towards the end of the year where it feels like, boy, it seems like I'm going to the doc all the time. Or it's, oh boy, I'm going to go get a new pair of glasses or a new pair of contacts, or I'm going to get a checkup or whatever. Well, maybe as a family situation, you've got a decent amount of money left in this flex medical account that's got to be spent before the end of the year or you lose it. Now, that is different from a health savings account in the fact that a health savings account is your money and your money goes with you. So if you don't spend it in a given year, that's okay. It just rolls over into the next year. Some people have it's called a savings account. It's almost like it's a health debit card. And your money's your money, and you use it on qualifying things, medicines, copays, surgeries, medical devices, buying a knee brace, or whatever. It's obviously not going to Kevney Drug and buying vitamins, right? That's not a qualifying medical expense. But if it does qualify as a proper medical expense, it's like a medical checkbook. But again, the money stays with you if you change jobs. If you don't spend it at the end of the year, it stays with you. So difference between your HSA, health savings account, and your flex medical is this is use it or lose it money. This is money that you get to keep and you get to roll over even if you leave a specific job. So as we look at some after-tax items, healthcare costs are a big one. Dental and vision insurance, which again is healthcare. They have life insurance, they have long-term care, and you could do some after-tax investing like Roth IRAs, um, maybe a stock option where you're buying company stock that they will take out of your paycheck before. Again, these are all choice items. No one's going to make you do these, but they are money that would be deducted out of your paycheck after you've already paid your taxes on your paycheck, after they've already calculated federal, state income, social, Medicare. Health insurance premiums is the most common one. Not many businesses are going to pay the full sticker price for your health care. Some will, but most won't. So on a paycheck by paycheck basis, you're expected to cover a part of those premiums, whether it's on yourself as a single person or whether it covers you and all of your spouse and all of your children. Right? It's called family health insurance. So different kinds of things that could come out of your paycheck after it's taxed, or some of the ones we covered that were before. So as we look at a paycheck flow, and again, I'm not going to ask you to take notes on this. This is just more of a general. You've got your hourly and your overtime plus your salary. Maybe you add a commission. Maybe you add a bonus. We'll be doing a homework assignment on this. You get what we call your gross earnings, right? Total earnings, gross earnings means the same thing. Here you have some pre-tax deductions, and I gave a couple examples, but not all of them. So gross earnings minus your pre-tax deduction gets you to what's called your taxable earnings. Here's where I then say, take my taxable earnings, calculate my federal, calculate my state social Medicare, calculate all my payroll taxes. Then I go ahead and I have my post-tax deductions or my after-tax deductions, health insurance, whatever it happens to be. And then that gets me down to my take home or my net pay. Right? What do I actually get by the time this whole thing is done? So that's our pre-tax, post-tax. What are some other benefits, both literally and figuratively, to working? You have some benefits that are non-contributory, meaning it's a benefit that is completely paid by the employer. There's no cost to you. And you have benefits that are contributory, right? Like health insurance or 401ks or 403bs, right? They're taking your money to pay for some of these benefits. Some of the other benefits, like maybe a pension plan or paid time off or things like that, are non-contributory benefits, right? The company just gives it to you without anything coming up from you. And these are some of the enticements to make you work for the company, some of the perks, if you will, to work for the company. But again, it's why we say you are more expensive than your hourly rate of pay, because these things do cost money. So we'll start out with the one of the most common ones, something called PTO or paid time off. Now, some people will call this vacation days, some will call it personal days, some call it sick days, some call it discretionary days. You essentially talk to your employer and say, I'd like to use a day and still get a paycheck, right? I'm going to take Thursday and Friday off. Why? Doesn't matter, right? You're sick. You've got a dentist appointment for your kid. You're going to see an ailing grandparent. You just want a vacation. You're tired and you just need a day off. So whatever it happens to be in your paid time off, whether it's a full day, whether it is by the hour, you are making the choice to take time away from work, not be at work. You still keep your job. You still get paid, right? The same amount of pay. Every business is going to have their own criteria. Again, we're talking older, done with college, full-time work. you may start out with 1 week, right? 5 days or 7 days or maybe 10 days of time off. Um, some businesses say you get a day off for every 2 months you work here, or whatever that is. And every business is going to have their own limits. When you're first starting out and working, it may only be a week or 2 weeks, right? You've been working somewhere for 10, 15 years. Maybe you're up to 7, 8, 9 weeks. Um, some businesses will allow you to carry a certain number of unused days forward to the next year. Sometimes it's like 5 or 6. I know Mrs. Clem has had some situations where, and again, I'm just going to make the numbers up. Her employer gives her 20 days of paid time off, 20 days of vacation or sick time or whatever you want to call it. And they'll let her carry up to 5 over. So she can use 15 this year. She doesn't have to use all 20. But then she can carry 5 over to the next year, and now year 2 she's got 25 days, 20 new days off plus 5 carried over from the year before. But again, it's not like you can bank hundreds and hundreds and hundreds of days, or at least not a lot of companies do that anymore, where you just keep banking your days and get cashed out for them. Some of them might. Other benefits that we've already talked about a little bit here are retirement plans, whether that's a pension, which is a non-contributory plan, or 401k, 403b that are contributory, meaning these two, you're putting your money in. This one here, the company is covering it for you. Some other benefits that we've talked about, again, are dental, health insurance. They may offer you to buy life insurance at a very discounted rate, right? And it may not be millions and millions of dollars of life insurance, but maybe they'll give you, if Mr. Clem dies, they'll pay Mrs. Clem twice his annual salary. So if I'm making $50,000 a year and I die for whatever reason, the school will buy an insurance policy on me while I'm living and working, and they'll pay Mrs. Clem twice my salary, so $100,000 in that made-up example. And again, your flexes, your flex daycare, your flex medical, your HSAs, these are all benefits. So we're going to hit the pause button here, and we'll move on with our next video talking about general concepts on insurance.